going to close in 10 years, then you should be a Copart bear. And if you believe it's going to happen in 20, 30 years, then you probably should think about being a Copart bull, especially because once autonomous gets here, it's not going to be automatic, right? So people will have to first trust and then purchase autonomous vehicles. And then it'll take, let's say, a decade or so at current replacement rates to get a fully autonomous vehicle fleet. And even then, in other countries, it will probably be much later, right? So I think that's one of the things to consider. And then the other one is that Copart is increasingly pivoting to non-insurance volumes. If autonomous takes a lot of time to come to fruition, then Copart has more time to diversify away from insurance volume and therefore from being exposed to the number of accidents or the number of total cars.
Hey everybody, welcome to the Investors Podcast. Today we have an exclusive YouTube interview with my friend Leandro, who's an analyst and writer at the Best Anchor Stocks. And during this interview, we're going to be covering Copart, who's likely well known by a number of our listeners. So it's just great to have the opportunity to interview here, Leandro. You do just amazing work, and I applaud you for the wonderful research you do at Best Anchor Stocks.
Thank you for having me, Clay, and thank you for the kind words. It's great to be here.
Well, I've wanted to cover this business on the show in more detail than I have in the past. I've covered it a couple times at a more high level. I did a review of Willis Johnson's book, Junk to Gold, on episode 601 of the podcast, for example. And Copart is a popular company in the world of quality investors, and it's also been a top performer over the past 20, 30 years. So you first wrote about Copart on Best Anchor Stocks back in June of 2022, and that was when the stock was around $22 a share. And now, just over 2 years later, again, been a top performer. It's around $56 a share as of the time of recording. And you have a Best Anchor Stocks checklist where you rank each company you do research on, and you rank it based on conviction, competitive advantages, growth opportunities, management, among other factors. And to the best of my knowledge, Copart ranked among the highest of all the companies you've profiled. So you can correct me if I'm wrong there. And many people, I think, will look at a company like Copart. They'll see a PE of 35 or a PE of 40, or maybe even the PE of 25 when you first covered it in your research, and just stop their analysis there. That's where they end their analysis on the stock. So how about you talk a little bit about what led you to digging a layer deeper on this company and what made it qualify as the Best Anchor stock for you?
Great. So I think the first thing I would say is that I always tend to look at valuation last, because if not, you can miss companies such as Copart, right? And it's impossible to judge valuation based on just a multiple. So how I discovered Copart is actually how I have discovered a few companies, which is by reading a book related to the company. Like you said before, and you've had a great episode on the book. I read From Junk to Gold, which is the biography of Willis Johnson, which is Copart's founder. And that obviously got me to dig deeper into the company. And at this time, I didn't even know what the PE multiple was. I was, let's say, not fell in love, but I quite liked Willis Johnson's way of seeing business and how he looked at the growth opportunities for the business. And basically because it was founder-led, and you can clearly tell that this guy had founded the company from scratch and was basically now a multi-billion-dollar company. And obviously he's also a billionaire. So he is like he portrays the American dream. So I think Copart has certain qualities that make it a good, I would say that at the time that I included it, I would say at a good investment. At this time, I would say it makes it a great company, maybe not so good of an investment. So I think it has very strong growth opportunities, and in a market that it's historically been seen as boring, which is the salvage industry, and we'll talk about it later. It has extremely high barriers to entry and it operates in an oligopoly, right? And out of the oligopoly, Copart is the strongest player. And I think there's no discussion about this, especially over the last few years. I think also one thing that's very important, which relates to the book From Junk to Gold, is that Copart has aligned incentives, right? The management team, the founder and his son-in-law own around 9% of the business. So that's also a plus. Then also something that I think it's very rare to find in public markets is a company run for durability and not run for, let's say, short-term return maximization, which is what a lot of shareholders want. I think this is very easy to find in companies where ownership is huge, like the founders have a significant part of the business, so then they can basically make the decisions unilaterally. So I think that's also a very strong point for Copart. And I think the remaining point is that it's a very resilient business, right? I mean, we'll talk about the variables later on, but Copart is a business where the variables, doesn't matter how they move, the business has some sort of natural characteristics that makes it resilient against that movement. So I think those are the main characteristics that made me include Copart in my portfolio, and also that the valuation back then was fairly attractive.
For We Study Billionaires, I'm working on a couple of interviews or episodes, and I'm chatting with Dev Contasaria next week, and I'm reminded of how he's not an investor in Copart, but he only invests in monopolies or duopolies for certain reasons. And I think that attracts a number of people to Copart because they compete primarily with IAA and they have a strong position against them. So that can give them some very good characteristics from an investor standpoint. And then I'm also wrapped up this book called Quality Shareholders by Lawrence Cunningham. And I think there's a lot of parts in that book that can tie into Copart, whether it be, how long-term management thinks, how they're able to attract a lot of quality shareholders that are willing to just sit on the stock for a really long time and help them weather through certain things. And those are 2 points where some of these episodes can complement each other and conversations and interviews we do. And I think studying a company like Copart and, reading a book like Quality Shareholders, you can almost find these ways to almost do better within your own business. And I just find that super fascinating as well. So even if you don't buy a stock like this, you can still learn a lot about, how a great management team thinks and how they think about durability and the long-term potential of their company.
I completely agree with you. I think that one of the reasons why I don't like to look at PE multiples or valuation multiples before studying a company is that you are first, if you wait for the multiple to come down before you look at it, then you're going to be probably biased in your analysis. And secondly, because you are always going to get something out of studying a high quality business in what relates to, for example, pattern recognition, right? I mean, if you look at a lot of quality companies, you'll find patterns that are common across them. And you can only get that if you study a lot of these businesses.
Wonderful. So let's dive into, from a high level, what does Copart do?
So Copart operates in the salvage industry, and I think the best way to understand Copart is not through its reportable segments or its operating segments. I think it's better to look at it from the point of view of the insurance business and the non-insurance business. So in the insurance business, Copart basically helps insurers manage totaled cars, right? Let's say you are in an accident and your car gets totaled, then Copart will help that insurer manage the life of that car, the remaining life. So Copart will be the intermediary between the insurer and someone who wants to buy the car, and it will take a cut of that transaction. That's the insurance business. And the insurance business is obviously dependent on accidents, right? On cars getting totaled. Then the non-insurance business is somewhat similar in terms of the platform, but what changes is the source of the volume. So in the insurance business, volume comes from insurers, while in non-insurance, as the name evidently portrays, comes from non-insurance sources like charities, you can have financial institutions, and also maybe rental car companies, right? So it's basically the same, but the non-insurance business, the source is different and doesn't need to be from total cars. In fact, in most of the non-insurance business, cars can be in perfectly drivable condition, right? So you're basically selling used cars more than selling total cars. So I think those are the two main segments to understand Copart well. And I would say that it's important to understand how the salvage process works, especially in the US. So if you're in an accident, your insurer basically has two choices, right? They can repair the car or they can pay you the pre-accident value and then the car is total, right? And they'll keep the car and then they can do with the car whatever they want. So their decision of what to choose here will come from a formula, right? And I'll do it numerically. I won't do it with a formula, but for example, if your repair costs are $5,000 and the pre-accident value is 10,000 and the insurance company believes that they can at auction get $6,000, then they will salvage the car, right? Because they are losing less money by paying you the $10,000 and then making $6,000 on the car. Their net loss there is 4,000 than repairing the car, which is 5,000. So Copart evidently plays a role in the part where insurers decide to total the car, not when insurance decide to repair it. So I would say those are the two main segments of Copart. And it mainly operates as an intermediary in both cases, right? And selling the cars on behalf of the sellers, which can be insurance and non-insurers, to the buyers, which can be basically anyone, right? Buyers can be in total cars, probably repair shops are going to be a very important one. It's very important Copart has an international buyer base because a lot of these cars that are not fit to drive in the US might be fit to drive in other countries, for example, in the Middle East, right? That's also important. And Copart basically takes, among other fees, the most important fees is probably the fee that they take when the car is sold through their platform.
Wonderful. To the best of my understanding, these relationships with these insurers are certainly important and they add a lot of value to these insurers. And the business was founded in the 80s, if I'm remembering correctly. Do you remember or do you know how sort of the industry structure worked before Copart, was a part of this sort of ecosystem? Like, how did an insurance company get rid of a total car prior to Copart being on the scene?
Well, I don't know it exactly how it happened before, but it was 100% more decentralized, right? There wasn't two large companies which were driving most of the volume. So I imagine that from an insurance point of view was worse, right? Because you have to deal with many companies or many salvage yards instead of being able to deal with one or two companies. This said, obviously insurers don't want to deal just with Copart, right? They also want to have some kind of leverage, which is why I think the industry eventually evolved to an oligopoly. And to be honest, it's going to be tough to see it evolve to a monopoly, even if Copart is the superior player, right? Because the insurers would never want that.
How about you paint a picture on the revenue breakdown? Most of their revenue comes from the transaction fees, and then they also have the service vehicle sales. What does that look like for them?
Yep. So before I said that I was not talking about reportable segments, because what you just mentioned are actually the reportable segments, which are vehicle and service revenue. So service revenue is all the fees that Copart takes as an intermediary. The most important of these fees is obviously the one that they take based on the transaction value. This is basically a segment where Copart acts as an intermediary, so they don't take ownership of the car in most cases. Then in vehicle revenue, you have cars that Copart does take ownership of. So Copart from time to time will buy cars and then will sell them in their platform. And obviously they'll make the difference between the buying price and the selling price as profit. This is, I think, around 16% of revenue, right? So it's not huge in terms of revenue. Most of revenue comes from service, but it comes in handy from time to time, especially when volumes are depressed from insurance sources. And this can definitely happen when prices are skyrocketing. So Copart, for example, when used car prices started going up, let's say 2 years ago, they leaned a bit more into vehicle sales because they wanted to complement the revenue that they were getting from insurers so that buyers would have a lot of inventory to choose from. So those are the two reportable segments. And then the company also reports US and international revenue. The US makes up the majority of the revenue. I think it's above 80%, but they have been increasingly diversifying to international. So I would say as a summary, mostly service revenue, mostly US. And then I wouldn't say vehicle revenue is a nascent part. I think it's a complement to service revenue. But in the case of international and the US, international is probably a nascent part and will make an increasing portion of the revenues if everything goes well over the next 10 years or 20 years.
I think it's also important to understand the industry dynamics overall. So you did a 5-part write-up in your research, and just one of those articles was on the industry dynamics. So talk about some of the key factors that play into this.
Yeah, so the most important variable for Copart, at least in its insurance business, which is the majority of its business right now, so it's probably the most important variable for Copart, is the total loss ratio. So this measures basically out of the cars that have been in an accident, how many of them get totaled, right? And the more the cars get totaled, then the more volume Copart gets and the more cars it can obviously sell through its platform. This ratio has been trending up over the last couple of years, despite lower accident severity, right? Thanks to the advanced features, technology features that the cars have. The reason is that now cars are so technologically advanced and have so many sensors and cameras that even a small bump can create a repair of thousands of dollars, right? So cars are getting totaled at an increasing rate. This has additional benefits for Copart besides more volume, because Copart also gets higher quality volume. If our car has a bump in the front and that repair costs $3,000 or $4,000, that car might get totaled, but it might be perfectly safe to drive in another geography. So Copart is getting more volume and volume of a higher quality, which is good for margins because Copart makes a commission based on the transaction value. So if you sell, Copart prefers to sell a $10,000 car on its platform than a $3,000 car. I mean, it's much more profitable for them. So obviously the risk, and we'll probably go into this later on, is that if autonomous eventually comes, then the accidents are going to be reduced. But everything that happens between today and autonomous driving is a tailwind for Copart because repair costs are going through the roof. I mean, I remember someone hit my car, the rear of my car, and it basically broke a plastic piece. Well, changing that piece was 700 euros. Obviously, my insurance paid for it, but I mean, it was impossible to have a less severe bump in the car, and it was already 700 euros. So then that's where you start to see the bull case here, right? Cars are getting totaled at a faster rate and in better condition. So that's good for Copart in any case. And obviously, I would add that the company is in no need of accidents, or not to the same extent in the non-insurance business, right? So that's obviously something that helps it, let's say, protect against the risk of autonomous.
I'm interested in hearing more about that last point you made. So you said for the non-insurance business, accidents aren't something they necessarily rely on. So why is that?
For example, you are a financial institution and you got a car as collateral and you want to sell that car. That car is not necessarily totaled, but you want to sell it. So you go to Copart and you sell it on the platform because there's a lot of liquidity. Another example, you're a rental car company and you have a car that has some minor scratches. So it's not total, but you want to sell it because you want to renew your fleet. So then you sell it through Copart. So you don't basically need an accident to get volume on the non-insurance business. On the insurance business, you 100% do, because it's going to come from total cars. That's what I was referring to.
That totally makes sense. Another point I'll touch on here is the average age of cars. So you showed this chart. Back in the 1970s, the average age of a car was around 6 years, and around 2020, it was around 12 years. So one would think that the older a car gets, the easier it would be to be totaled. Is that sort of your line of thinking on that?
Yeah, that's one of the things that we should get away from that chart. The other one is probably that it's the average age of the fleet is a protection against the autonomous risk, right? Because a fleet of 13, and that's 13 years old in the US, means that if next year every car sold is autonomous, it would take around 13 years to replace the entire fleet. So obviously, even if autonomous is a reality today, we're still a decade away from autonomous probably making a significant dent in the company's volume. And I think that's also important to point out, right? Because when I always talk with someone about Copart, I always say that the difference between a bull and a bear in Copart is probably the timeline of autonomous, right? Whether if you believe autonomous is here to like widely spread in the car fleet, in the vehicle fleet in 10 years, then you're honestly going to be a Copart bear. And I can completely understand that. If on the other hand, you think that autonomous is not going to play an important role for Copart's volume in the next 30 years, then I can understand why you could be a bear, especially because Copart is going to have a lot more time to diversify away from insurance volumes to non-insurance volumes. So I think that's something that we should take away from that chart too.
Another piece of this puzzle, I think, is looking at used car prices. So after COVID, the used car prices just took off, rose well over 50%, and now they've come back down and sort of normalized. It's interesting looking at Copart's financials to see, a nice bump in revenues, say 20 to 30% in 2021, 2022. And then the growth is still there, but it's come down for Copart. So it's surprising to me a bit to see just how stable their business has been in light of the volatility of used car prices. To what extent, how do you think about used car prices in relation to Copart's business?
As I said before, Copart is a great business because it's, let's say, insulated from movements in the key variables. Used car prices are a great example. Before, right, let's say before all this technology trend in cars, when used car prices went up, then Copart would technically get less volume from insurers because it was much tougher to total a car. But on the flip side, the average selling prices on their platform would go up. So then they would sort of compensate while at the same time getting higher margins, because selling a higher ASP car is better than selling two cars because it doesn't require more capacity or handling the car or the cost of handling the car. So that's how it was before. Now, I think it has surprised the market over the last 2 years, and that's why Copart has done so well, is that Copart probably is living today in the sweet spot, right? Used car prices based on the Mannheim index have come down significantly. But because cars are becoming more technologically advanced, then Copart is getting higher quality volume. So Copart's ASPs are becoming more, let's say, resilient. They are not as closely linked to the Mannheim as they were in the past. And you also have to factor in the non-insurance volumes, right? Non-insurance volumes obviously are going to be more resilient because you are putting into the mix, into Copart's insurance and non-insurance mix, you're putting in higher quality cars. So you're getting right now, with decrease in used car prices, what you're getting is more volume because the total loss ratio is going up, but at the same time, higher quality volume, which is keeping the average selling prices stable. So it's sort of the sweet spot for Copart right now. I think it's going to probably last quite a bit, right? Because this is a trend that's just starting, and Copart's volume, probably majority of it comes from the insurance business. So it's not all like the highest quality that it could be. And I think this is what has taken the market by surprise, right? Before, lower or higher ASP is sort of a trade-off. And right now that it seems that lower used car prices are all playing into the favor of the company. So I think that's something that's probably core to the company's performance over the last year or so.
Mm-hmm. I recall I interviewed John Huber on Millennial Investing 2 or 3 years ago, and we were talking about moats and competitive advantages. And I remember he discussed just some of the best businesses have multifaceted moats where there's not just one factor at play, and there's actually multiple, which make it exponentially difficult for existing competitors to compete, or close to impossible for new entrants to enter the market. And one thing he also mentioned that I think is quite interesting and easy to understand is just the NIMBY effect of Copart has all these junkyards all across the United States, and no one wants a second junkyard in their local area. That alone, I think, can be a strong moat. What are some of the other factors that play into Copart's moat?
Hey everybody, it's Clay Fink here, host of We Study Billionaires. One of my favorite things about being a host of this show is having the opportunity to host live events for our TIP Mastermind community. We just recently hosted our live events in New York City, where I got to meet up with members from all over the US, Canada, and the UK. We gathered to have great food and interesting conversations, and also enjoyed seeing the city as we hosted a boat tour to experience all of what New York City has to offer. For our mastermind community, we host 3 live events each year. We have Omaha during the Berkshire weekend, New York City in the fall, and London typically in the fall as well. What makes the live events so special is having the opportunity to have authentic and real connections with successful people who come from all walks of life. Some members are entrepreneurs, some are private investors, and others are equity analysts and portfolio managers. But we all have one thing in common. We're value investors and we're there to learn and engage with like-minded people. In addition to our live events, we also have a platform online where members can talk stocks and share ideas, and we also host weekly live Zoom calls that we record for the group.
One of the things I really appreciate about this mastering community is that you meet like-minded people from all over the world and you have a chance to hang out with them, have a ton of fun, and also talk about investing.
So if you're not into meeting up in person, we also chat online about our stock ideas, what books we're reading. We host Q&As with special guests like Chris Mayer and Gautam Bade, and members oftentimes share their portfolios and the opportunities that they're currently looking at in the market. One member, Chet, recently told me that he is consistently blown away by the quality of the content and the members in the group. And David, who's been with us since the beginning, has brought me one of the most valuable friendships I've ever had. Whether you want to talk stocks or simply just want to network with like-minded people, I'd encourage you to apply to join our TIP Mastermind community today, as we're capping the group at 150 members. Simply go to theinvestorspodcast.com/mastermind to join the waitlist today. That's theinvestorspodcast.com/mastermind. Buy low, sell high. It's easy to say, hard to do. For example, high interest rates are crushing the real estate market right now. Demand is dropping and prices are falling for many of the best assets. It's no wonder the Fundrise flagship fund plans to go on a buying spree, expanding its billion-dollar real estate portfolio over the next few months. You can add the Fundrise flagship fund to your portfolio in just minutes with as little as $10 by visiting fundrise.com/WSB. That's fundrise.com/WSB. Carefully consider the investment objectives, risks, charges, and expenses of the Fundrise flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/flagship. This is a paid advertisement.
Yeah, so I think Copart has two sources to its moat. And the interesting thing is that one of the moats is physical, and is the one that you just described. And the other one is, let's say, one of intangibles. So the physical moat is obviously the salvage yards. Copart has been investing for years into land and buying it, while its competitors were leasing the land. And this is important, right? Because if you buy the land, then that land cannot be repurposed. But if you are leasing the land, then that land can in the future get repurposed, used different to a salvage yard. So I think that's something worth taking into account. So obviously, if you want to compete today in the market, you need to spend a lot of money to get all the capacity that Copart has. And you're going to face significantly higher costs, right? Because you have a lower density. And density in this case allows Copart to be closer to the salvage yards. Besides the fact that you need capital, it's almost impossible to do it regulatory-wise, because right now you may be able to buy a salvage yard in the outskirts of the city, but Copart has some salvage yards that it bought several decades ago, and while this at the start might be at the outskirts of the city might have grown, and now they're actually quite close to the city. So it's basically impossible to get those salvage yards anymore, because you're not going to get the permitting required to do that. Then the intangible mode is actually quite interesting, because Copart's main competitor, IAA, pivoted to fully online auctions during COVID, because basically it was a necessity. But until that time, they were running also physical auctions. Well, Copart made this transition in 2003. So obviously Copart, during this transition to, let's say 17 years earlier than its competitor, built a huge buyer base of international buyers, right? Because obviously if IAA is doing physical auctions, you're not going to have as much international buyers. So Copart amassed this huge international buyer base, which improved liquidity in the platform. And now it's very difficult to come against that, right? Because it's the classic two-sided flywheel, right? Because insurers want to sell the volume where there's a lot of liquidity, because they're going to get higher auction prices. At the same time, buyers want to be where there's a lot of inventory. And the inventory is going to be at Copart, right? Because most people want to sell in Copart because they get higher auction prices. Let's say powers this self-reinforcing flywheel, which is very difficult to disrupt. Obviously, as I said before, an insurance company is not going to give all the volume to Copart. They also want to have volumes with IAA, especially not only to have leverage, but also so that Copart doesn't start charging too much, right? So they want to be able to compare at all times. But I think these two modes, in my opinion, together make up the strongest modes that I personally have ever analyzed.
Here this Thursday, November should be 14th, Kyle and I did a deep dive on MasterCard, and we found the same thing where with Visa and MasterCard, it's a chicken and egg issue where, you know, every card holder uses a Visa or a MasterCard because it's accepted everywhere, and every merchant accepts Visa and MasterCard because every card holder has it. So it just makes it extremely difficult for a new competitor to enter the market. I'm curious, you mentioned in one of your articles that Copart and IAA compose of around 80% of the market. Do you think they're taking share not only from IAA, but the remaining, say, 20% or so?
I would say they are. And for that similar case, right? I mean, Copart is going to have more liquidity. So they're basically going to have higher option values. I mean, if you're a small salvage yard, then you may get some local volume, but a big insurer probably would never sell to a local salvage yard or do business with them, because if you have 20 eyes looking at that car, you know that you're going to get probably a lower price than if you have 200 eyes looking at that price and bidding for it. I think Copart is currently continuing to take market share from IAA. It was definitely the case when IAA was publicly traded, but IAA was bought by Ritchie Bros. So now it's much tougher to look at the different market share, but probably it is. I mean, when I was looking at IAA, one red flag that would always stand out to me was that the CEO was saying that volumes were up if you excluded the loss of a large insurance customer. And I'm like, well, that's part of your business. How are you going to exclude that volume? I mean, the remaining volume, I imagine, is coming from insurers too. So if you lose them, you're going to adjust for it. So I think that was one of the things that made me realize that execution and maybe transparency was not the same at both businesses.
Yeah. For the video I did on Copart, there was this slide that reviewed and compared just Copart to IAA. And it's just eye-opening, just looking at the differences and how management thinks about capital allocation, owning versus leasing the land, paying out dividends for IAA or reinvesting everything for Copart. Like, that is one thing that really stood out to me when looking at Copart, because, you know, like I just mentioned, Visa and MasterCard is two very strong players that aren't necessarily trying to steal too much share from each other. You know, it's a natural duopoly, whereas Copart, they just continue to eat into these weaker competitors.
Yep. So for people that are maybe willing to look into Copart versus IAA in the past, they should take into account that Copart is going to show significantly higher P&L margins just because they are not leasing the land, right? So obviously IAA is expensing this cost and Copart is not expensing this cost, but then you see it through the CAPEX figure in free cash flow. So I think that's a difference worth taking into account. Either way, I think Copart is a better business. Even if you adjust for that, Copart has higher margins, but obviously the difference is not so wide as it appears at first sight.
How about we touch on Copart's management team? They were founded by Willis Johnson back in the 80s. And I love the story of the son-in-law, you know, taking over the business and now sort of running the show. So what's important to share on this front?
The company is currently run by Jeff Liao, who joined the company in 2016. He's been in the position since 2022, but he is the sole CEO for some months because for the first 2 years, he was the co-CEO with Jay Adair, which is the son-in-law of Willis Johnson, the founder. So both Jay Adair and Willis Johnson still remain on the board and they hold 9% of the shares. But right now, the company is operated by a non-founder, or let's say no JR or Willis Johnson. The management team lately, I think what I would highlight is that it has gotten a bit larger. And this might sound a bit worrying, right? Because you're seeing more managers coming to the management team. But I think it's also natural because Copart is diversifying to non-insurance volumes. And I think those volumes require a different kind of, let's say, managerial positions than insurance volume, right? So one example might be a chief marketing officer. You previously didn't need that, right? Because the insurance space is super concentrated and you know that you're going to have to you need to talk to, let's say, 10 customers and you're getting most of the volume from them. But in the non-insurance space, probably the seller base is much more fragmented. So then you need different, let's say, expertise on the management team. I think it's a very capable, long-term oriented management team. It's not rare to listen to a Copart call and listen to management talking about 50-year horizons. Probably that's a stretch, but I mean, to be able to think for the next 10 years, you at least have to be thinking for the next 50. And I think the track record speaks for itself, right? And Copart rarely goes to investor conference. They've started to do that more often right now, but they rarely go to investor conferences. Their earnings calls are you can clearly tell in the earnings call that it's not a management team that's promotional. They basically just want to talk about their business and tell you what they're doing in their business, but they're not going to be overly promotional. In fact, they are quite conservative. And one of the things that I also like about Copart is that it doesn't give out guidance. I don't know, and I have not conducted a study whether that companies that don't give out guidance are better investments going forward or maybe less prone to financial fraud or earnings manipulation. But I find that a company that doesn't give out guidance is for sure in a position to be able to think long term. And in fact, with Copart, you can clearly see that a lot of analysts rely on guidance, right, to set their estimates, because with Copart, they are never even close to the numbers because Copart doesn't give guidance. And also, I must say, in the favor of analysts, Copart is also exposed to volumes from catastrophic events, right? And there's no way that you can forecast that in your model. But surely someone is trying to forecast for that. So I think the management team is very high quality and aligned with shareholders and also thinks very, very long term, which is something that I like.
Yeah, you made some good points there. It was actually yesterday I was reading in Cunningham's book, Quality Shareholders, and he talked a bit about guidance and how companies who don't issue guidance are able to attract quality shareholders because it's keeping all these short-term players out that want to know what's going to happen over the next quarter. And Cunningham makes the point where, even management isn't able to accurately predict what the business is going to be over the next 3 or 6 months or whatnot. It's nothing more than a guess in many cases. And he also made the point that it takes time and it takes resources to figure out these forecasts. And, if they're not adding significant value to the business, then they're largely a waste of time and nothing more than just trying to appease certain cohorts of shareholders like your analysts and whatnot. Let's turn to capital allocation here. So I pulled up their cash flow statement and saw around $1.4, $1.5 billion in cash flow from operations. Close to zero is going towards share repurchases. Nothing is going out as dividends. Where are they reinvesting all this capital?
So Copart reinvests most of their capital into capacity expansion, and that's mainly land. So they keep buying land because they believe they'll have significantly higher volumes in the future. Also, Copart, before a catastrophic event, for example, the hurricane in Florida, they'll purchase capacity even before it comes, just to be prepared. So when it comes, they have that capacity to service their customers. So in a sense, Copart is never operating at an optimal capacity level, right? They always have overcapacity. And I think this is something that one should also take into account when looking at margins and when looking at the capital intensity of the business today. As you said, they don't return money to shareholders through dividends. They don't either repurchase stock. They have repurchased stock, I think, 3 times over the last decade when the company was not trading at very attractive levels. Very attractive levels in terms of that the price was not high. They were attractive in terms of valuation. And those have played out quite well, all of those purchases. And they will from time to time make some acquisitions, especially now that they are diversifying away from the insurance business. For example, they acquired Purple Wave, a company that has a platform to sell secondhand heavy equipment. So they are diversifying. Copart is trying to diversify it also away from vehicles and to the heavy equipment business. Management will always tell you that they already had that type of equipment, although in small volumes in the current business. But obviously the acquisition of Purple Wave, let's say a much firmer bet on diversifying away from vehicles. So if you look at CapEx, I think CapEx intensity is right now around 12%, and it has been above 10% for a greater part of the last decade. So obviously, when one thinks about future cash flows, they have to think that if growth is going to be absent, then probably CapEx intensity is going to be much lower, right? So free cash flow generation is going to be much higher. And then Copart has also used the cash generated throughout these years to build a substantial cash position. I don't have the number right now in my head, between 2 and 3 billion, I think it is. And the company has no debt. So basically it's an immaculate financial position. And the reason behind that financial position is that the company wants to be able to last and also give the confidence to its customers that they will be here, they will be around in 20, 30 years or whatever happens, whatever recession comes, so that they can service their volumes. One of the good things about Copart is that it's pretty resilient to an economic recession, right? People drive less, but there are still accidents and also get totaled during recessions. So obviously, it would be terrible for Copart's customers to see Copart struggle during a recession while needing to service their volume. So that's one of the reasons behind the cash position. So I highly doubt shareholders are going to see anytime soon that cash position go into their pockets.
Yeah, I just pulled up FinChat. It shows 3.4 billion in cash and short-term investments. And go back to 2019, that was under 200 million. Which is, they must have been purchasing some shares potentially during that time period.
They did repurchase a bit in 2020. And also in that number, you also have obviously the higher interest rates. Copart has been making quite a bit of interest income.
Yep. My next question that sort of ties into capital allocation is, if this is a optically high multiple, arguably expensive looking company, and 80% of their revenues, around 80% of their business comes from the US. Is this largely a bet on international expansion, or is there other areas where growth could potentially come from?
Okay, so while 80% of the revenue comes from the US, that means that the car is sold from the US, not that it is sold to a US customer. So actually the US business is more diversified in terms of buyers than it actually appears to, right? Because if you have Middle East customers buying cars from the US, then that would count as US revenue. In international revenue, you have volumes that are sourced from international countries. And I think international is some sort of optionality, but it's tougher for Copart to grow in those markets because in many of these markets, the model is different to the US. So for example, in the US, once a car has been totaled, then the ownership goes to the insurance company. That's not the case in other countries, right? In other countries, if your car has been totaled, that car is still owns, like you own the car, right? So then Copart, instead of dealing with the insurance business, has to deal with the individuals. And that's a tad more complicated. So the way that Copart is trying to approach this is by leaning more into vehicle sales. So they are purchasing the cars from the owners and then selling them on the platform so that the insurers see how good the returns are if they flip the model to service. I mean, there's regulatory barriers and everything, but they are starting to see some success in certain countries. You'll see that in international, probably vehicle sales. I don't remember the exact number, but vehicle sales is probably a significantly larger portion of revenue than in the US, which is mostly service revenue. So I think international is a good opportunity for growth, but obviously it's tougher also because in the US, you cater to one country, whereas in international, I think there are more divergences, right? So Copart operates also in Spain. Copart in Spain probably faces different problems that it faces in Germany, right? So they cannot put at the same time a common model for all of the European Union, for example. But as I said, the buyer base is diversified even in the US. So I think Copart is more international than it appears by its financial statements.
Yeah, it's sort of surprising to me that someone from the Middle East, for example, would want to purchase a car from the US, given how much it would cost to transport that over. I'm not sure if you have any comments on that, on why it makes sense to ship all these cars all over the world.
Well, Copart will actually do it for you. You'll pay for it, but Copart is the one that will send the car. I mean, just imagine that if a car gets totaled in the US due to a minor bump, or maybe the seat belts are not working, the airbags are not working, that car in the US is basically useless because you cannot drive it. Whereas in the Middle East, maybe you can, or in other countries that are not so developed as the US, you can maybe make certain repairs, very like, let's say low cost repairs, and that car is fit to drive. So I would say that the delta between the value that there's in the US because it's not drivable and the potential value that it can have to a Middle East customer because the car might be drivable, then the delta is quite large, right? So then it justifies probably purchasing the car and going through all the cost of sending the car and everything.
Mm-hmm. Let's turn here to talk about the risks. I think the main risk that is on people's minds is autonomous vehicles. So say tomorrow, if everyone all of a sudden has an autonomous vehicle, then you would think that much fewer accidents would occur, but it's not so simple in practice. So how do you think about this risk?
Well, I think the autonomous risk is a real risk, and any Copart shareholder is probably aware of that, right? The rationale, as you said, is that if autonomous ends up arriving, then the future is one of no accidents. But at the same time, for that to happen, you need a significant percentage of the fleet to be autonomous, right? Because if a car next to me is autonomous, but I'm not autonomous, I'm still going to act irrationally, right? So then I can get that car and my car into an accident. While we get to that optimal percentage where it becomes a volume headwind for Copart, I think there are several things to consider, right? The first one is that everything that happens between those two dates, like the arrival of autonomous driving as a, let's say, legally enabled way to, or technology to put in cars that is fully autonomous, and until we get to the percentage where it impacts Copart's volume, all of that is a tailwind for Copart, because then you have the different levels of ADAS, which is advanced driver automation systems. And all of that brings more technology and therefore more probability of a car getting totaled, right? So accidents in the meantime are going to be less severe, but while being less severe, you don't need such a severe accident to get a car totaled because just a minor bump can do it. And also the fact that technology is advancing so fast in cars also makes the value of cars go down quicker, right? So if I have let's say a 2-year-old car that has quite a bit of technology, that 2-year-old car probably is worth significantly less today than when you were thinking about cars 10 years ago, because it was basically very similar technology. Right now, it's different technology. And we have seen that, right? The car prices have risen a lot and the most advanced cars have lost a lot of their value. So that is one thing to consider. The other one, as I said, is that this gap, like how large this gap is important for the thesis, right? Because if you believe it's going to close in 10 years, then you should be a Copart bear. And if you believe it's going to happen in 20, 30 years, then you probably should think about being a Copart bull, especially because once autonomous gets here, it's not going to be automatic, right? So people will have to first trust and then purchase autonomous vehicles. And then it'll take, let's say, a decade or so at current replacement rates to get a fully autonomous vehicle fleet. And even then, in other countries, it will probably be much later, right? Because in the US, you may get autonomous. Maybe in Europe, you get it later. And obviously, in countries such as the Middle East, India, you're going to get it much, much later. So I think that's one of the things to consider. And then the other one is that Copart is increasingly pivoting to non-insurance volumes, right? So if autonomous takes a lot of time to come to fruition, then Copart has more time to diversify away from insurance volume and therefore from being exposed to the number of accidents or the number of total cars. And I don't know to what extent, but obviously when autonomous comes, a lower proportion of Copart's profits will be exposed to the autonomous risk, right? Because there will be non-insurance volume, which is growing faster than insurance volumes right now. Management doesn't share what's the percentage exactly of non-insurance versus insurance, but we know that non-insurance volumes are growing faster. So that's how I would think about this risk. Obviously, Copart trades at a premium multiple. So any hint of autonomous or any kind of news regarding autonomous can have an impact on the company, right? Maybe not through the profits, but how the market values those profits. So that's obviously something to take into account. You not only have to think about when autonomous comes, but you need to think 10 years ahead of that moment, because obviously the multiple is going to start to reflect that before it's even close to taking place.
Are there any other risks related to Copart worth highlighting other than autonomous vehicles and potentially valuation risks? So any other business specific risks?
I would say that maybe the international venture. Copart is investing heavily in international, and it's still an unknown whether that's going to be a business like in the US, right? Which is, I think, what people are expecting. It's still too soon to know. Things are going in the right direction, but still international margins, due to them also being a higher proportion of vehicle sales, are significantly lower than US margins. So obviously how that gap closes is also important. One could see it another way, which is to say that currently international margins are detracting from the company's true profitability. So maybe the multiple is not normalized if international ever gets to the margin profile of the US. But I think that's a risk, right? Because they've been investing significantly in the international venture. So how that plays out is important also.
I wanted to turn here to valuation, and to get this conversation kicked off, I wanted to share a quote from the write-up you did on justified PEs that I absolutely love. So I quote, "The market will almost always undervalue high quality, durable companies, period. Even if these exceptional companies remain undervalued, you will most likely have to pay what appears to be a premium price. Your margin of safety will not be in the price paid, obviously, but in the quality of the underlying business," end quote. Now, like I said at the beginning, many people are going to look at a company like Copart and just, stop their analysis at the PE multiple, saying it's too expensive. Chris Mayer's mentioned multiple times to me that people will talk about some of his holdings and they just say it's expensive. And yet a company like Copart continues to do very well in terms of its performance. Doesn't mean it's going to continue, of course. And one of the things I also appreciate about your service is that you share your assumptions when calculating what you deem to be the intrinsic value, and you also share your target buy range. So how about you walk us through how you think about Copart's intrinsic value today and what price would be an attractive entry for you?
Okay, so first thing, based on the quote, I still think that quote applies today. Obviously, there's a limit, but I think what that quote tries to portray is that if a quality company is trading above a market multiple, probably the gap between the quality company's multiple and the market's multiple is probably going to be not large enough to account for the quality of the company, right? And that's because these companies shine over the long term, and the market tends to overweigh what's happening over the short term, right? So I think that's an important thing to note. What I would say about Copart currently, I would say that it's definitely, in my opinion, trading on the expensive side of things. I think that's no secret. I think the last time I added to the company was March 2023, and it was trading around 29 or 30 times earnings back then, I believe. It's trading today around 40 times earnings. And I think the reason behind this is that what I mentioned at the beginning is that the market might have realized that Copart is currently living in the sweet spot of higher volumes with resilient average selling prices, which was not the case in the past. And obviously, the market thinks that warrant a higher multiple. I think I would also agree with that, obviously. In terms of valuation, well, you know that I like to use an inverse discounted cash flow model where I see what free cash flow growth is baked into the current valuation. For Copart, I used a terminal growth rate of 4% and a discount rate of 10%. And with those variables, I get that to justify the current price, free cash flow has to grow at a 22% CAGR over the first 5 years and 14% over the next 5. Over the last decade, free cash flow has grown at a 20% CAGR. And I think these two together are around 70% CAGR for the next decade, right? Definitely doable based on the past, but obviously it becomes much more of a challenge to grow free cash flow at that pace as one grows. Also, you have to take into account that over the last decade, Copart has grown its free cash flow at 20%, but it has enjoyed multiple expansions, so then returns have been exceptional. In the future, if let's say Copart manages to grow its free cash flow at a 17% rate over the next decade, but the multiple contracts, then obviously your returns are not going to be as exceptional. Not only because the company did not achieve the same growth, but also because the market did not value those earnings in the same way as it does today. So without going into much more detail, I think that a lot of the optionality that Copart has today is currently priced into the stock, right? And so I think it's doable based on all the optionality, but at the same time, I would much prefer to add to my position when the optionality is not priced in rather than when it is, right? Because I actually get the optionality. And the other way, I don't get the upside of the optionality, but I only get the downside in case it's not realized. So I wouldn't add to Copart personally at this level, right? In fact, one of the things that I regret is that when it was at more attractive levels, I was building my position slowly. So then I didn't get to add much to Copart. I think it's 4% of my portfolio now. But that's after a 110% run or something like that, I believe. And also something that I also mentioned before, and I think it's worth taking into account, is that when you're building Copart's free cash flow, like your model and Copart's free cash flow, you need to take into account that in the outer years, when you are dropping the growth rate to the terminal rate, you need to account for a much lower capital intensity, right? So then free cash flow in the outer years is going to have that tailwind of lower capital intensity. So Copart to grow, in my opinion, based on what I have done with my inverse DCF, because what I typically do is I first do the inverse DCF to find the free cash flow growth, and then I work from the free cash flow growth to understand what that might imply in terms of revenue growth, margin profile, the capital intensity. Obviously, that's an exercise only to understand if it makes sense, right? Because there are thousands of combinations that can get you to a given free cash flow growth. But that's how I do it. So for Copart to generate a 17% free cash flow growth over the next decade, revenue actually doesn't have to grow as fast. It has to grow around 10% CAGR based on my model again. That with some expanding margins will lead to, let's say 13, that's what I have in my model, 13% operating income growth. And then the remaining part of it is coming from improved cash conversion and also from lower capital intensity, right? So there's the delta between 17% and 13% of operating income. I also think that something worth taking into account is that Copart, through its business, because the company is making more economically efficient to total a car. So what management says in certain calls is that before an insurer even though they had to total a car, they didn't do it because they saw no viable alternative to doing it. But now they are increasingly getting an alternative because Copart's returns are higher. Copart is showing them and managing the process for them. So now even cars that were total before that were not auctioned through Copart might start going into Copart because insurers know that it's a viable alternative to the model that there was in the past. So that's one of the things that I think it's worth taking into account. And the other one is that you need a salvage title, right? For the car to be able to sold an auction as a salvage vehicle. And the process of getting that salvage title, it's quite lengthy, right? So Copart doesn't get a car and is able to immediately sell it because they need to wait to get the salvage title before doing that. Any improvements in that process of totaling the car are obviously going to be a tailwind for inventory turnover, right? So the Copart's bottleneck is not how much they take to sell a car. Copart's bottleneck is how much they get that car until they are ready to be able to auction it in the platform. So any reductions in that time is better inventory turnover and therefore better cash conversion. So that's also some of the things that I think one needs to factor into the inverse or into their model. And for me, an attractive entry point would be around $35 to $40. And that would mean that to justify that valuation, Copart should grow free cash flow growth over the next decade at around that 12% or 13% clip, which I think it's a pretty attractive entry point, especially since to achieve that free cash flow growth, probably your revenue growth is going to be in the high single digits or mid to high single digits, which I think is much more reasonable. Obviously, Copart, like all high quality companies, is probably going to surprise to the upside, and what you think it's impossible for them to do, they might achieve it. But as I said, for me, I feel it's much safer to invest when people don't think that's the case than when people think it's the case. And I think right now the market thinks that's the case.
So you mentioned, you added early in 2023, but you aren't a buyer of shares today. And it leads me to this question of buying versus holding a stock. And, I think if you ask a lot of quality oriented investors, you want to pay a fair price for a great business and then continue to hold that stock if it becomes overvalued. So when we look at something like Copart, maybe it was a pretty good entry point around when you added, but the stock's significantly run up partially because of multiple expansion. So perhaps the stock has, say, doubled, but the earnings have only increased, say, 20% or whatever it is. These types of, say, quality investors, let's call them, would say that we should let our winners run and not trim the flowers and trim the stocks that have made you all your money. And others might say that it's proper risk management to trim stocks that have gone up significantly, especially through multiple expansion, no matter how good the company is. And part of me is somewhat torn when I think about this, because what is the difference really between buying an overvalued stock or a highly priced stock and holding an overvalued stock? Because when you look at the returns for those two types of shareholders, they're exactly the same if we ignore like tax consequences of selling. So I'm curious to hear your thoughts on that in light of Copart or just holding great companies in general.
Yes, I think one thing to consider is your exposure to that company, right? I mean, if it has run up and it makes a considerable portion of your portfolio, then that may give you an additional reason to sell for, let's say, for risk management reasons. Copart, as I said before, I think it's 4% of my portfolio today, so it's not huge. And one of the things you mentioned there is taxes. So I think that's something definitely worth taking into account. So for example, if the multiple has expanded 50%, but when you sell, you need to pay taxes, the net multiple expansion actually after taxes has not been 50%, right? Because you're going to have to pay the taxman. I don't think taxes by itself are a reason to hold, right? But I think taxes are something you need to take into account before selling, especially because if, for example, you want to sell because you have found a better opportunity, that better opportunity has not only to do better than the company that you're currently holding, but it has to do as much better to compensate for the lower capital investment that you are having, right? And this is not something people tend to see, because when you sell a company, you're a broker, in your account, you're not paying taxes from that account, right? You're paying taxes from your bank account, probably. So then you might think, okay, I'm selling this for 1,000 and I'm reinvesting 1,000. Well, actually, that's not really the case, right? You're selling this for 1,000 and maybe you're reinvesting 800. So that's also something worth taking into account. I'm one of those shareholders, like you mentioned, that I continue to hold Copart despite thinking that it's not a buy at this level. One of the reasons is optionality, right? I mentioned optionality. I think Copart optionality is currently baked in to a greater or lesser extent in the stock price, but I don't know the extent of the optionality, right? It's impossible to know. I don't know if Copart will come up with a huge heavy equipment business in the future, or I don't know if Copart's international business will become as huge as it is in the US. That's basically impossible to know. I know that management knows how to execute, and if there's some probability of it becoming a driver for the business, then they'll for sure exploit that probability. But that's one of the reasons why I would not sell. Maybe I would consider trimming if I had it at 20% of my portfolio, right? Because that's not appropriate risk management to just focus on what might happen or optionality and have 20 or 30% of your portfolio in that. And lastly, I think it's also something personal, right? I tend to find challenging to sell a company and then buy into that company again. I could not explain why, but that's something that happens. So I prefer to purchase a company, and if it trades on the expensive side, obviously we're not talking here about 100 times earnings or something like that. If it trades on the expensive side, just holding and waiting for better opportunities. What's great about the financial markets, in my view, is that volatility is so high that even in companies where you think that you're never going to get a new opportunity to add at a fair price, you end up getting that faster in most cases that you ever expect, right? So I think that's also something worth taking into account. I don't think holding at any valuation makes sense, right? But I also think that selling when something seems a bit overvalued is a mistake. So probably the best strategy is the reality is somewhere between both, right? But that's how I see it. And I agree with you that there are some people who say that they'll hold companies even if they're trading at multiples that make absolutely no sense, right? And I think there are a couple of those companies in the market today, right? That you can obviously think, let's say a company trades at 40 times sales. Okay, so what are your assumptions regarding sales growth and what multiple of sales you are going to be able to sell that company in 10 years? I mean, you can make the numbers work for an 8% return, saying, for example, I don't know the numbers by heart, but I'll say, okay, sales are going to grow 40% per year for the next decade, and then I'm going to go out at an 8 times sales multiple. I mean, it's definitely doable, right? But what's the base rate on that? I mean, how many companies have been able to do that at certain valuations or at certain revenue run rates? There are not many. So I think that's something worth considering when you're thinking about selling, about valuation reasons. There are times that simply, it's not that it's going to be a poor investment. It's just that the risk-adjusted return, it's not worth it, right? Because you're taking a lot of risk just to get let's say a market-like return, which you can basically sell that and get that same return with the market with significantly lower risk.
Mm-hmm. One funny story I have with relation to Copart, I had lunch with a professional investor the other day, and he bought shares in Copart in 2006 and ended up selling them around 5-6 years later. And he said if he held on to that position, it'd be around 50% of his fund today. And yeah, I think with some quality businesses, you can't underestimate management who thinks long-term. They have a long runway to reinvest. And yeah, it might look cheap over, say, the next few years with decent growth. But like in your model, you're looking out 10 years, maybe Copart continues to grow at a decent clip for 20 years. Like that compounding is something, since our minds think linearly, compounding can easily be underestimated.
Yeah, I completely agree. And I think the toughest part of investing is realizing that a high quality company can surprise to the upside for many years, but at the same time, not taking that too much to the extreme in terms of what you are willing to pay, right? Because you can use that argument also to buy something that's trading at 200 times earnings. So I think it's finding a balance between knowing that a high quality company is obviously prone to surprise to the upside, but at the same time not falling prey of thinking that it's automatically going to happen and that you're going to make a good return irrespective of the multiple.
All right, so before we close out the conversation, I wanted to talk a little bit about best anchor stocks. So you have a fantastic paid research where you do all this research on companies like Copart and many others like ASML, John Deere. For those who subscribe, what can they expect from the service?
Well, they can expect very detailed research. At least that's how I see it. Also, access to my portfolio and all my transaction. I mean, everything is very transparent. I share my performance since inception, although I'd say the service is not about the performance, but about the research, right? Especially because I have subscribers who maybe own, out of the 16 companies currently in my portfolio, maybe these subscribers own 3, other subscribers own 4, and maybe some subscribers only own 1. So it's not about the returns of the portfolio, but more about the research. And obviously by subscribing now, you also get access to all the past research, right? So you get to all the historical, and obviously you also get direct access to me in case you want to talk about anything or need anything.
And what are some of the recent companies you've covered over the past, say, year or so?
Over the past year or so, John Deere is one of them. I covered them continuously, right? So I've covered companies like Constellation Software, Texas Instruments, Zoetis, and hearing these names and Copart and John Deere or whatnot, or ASML, you might think that I only look into mega caps. But the reality is that out of the 3 last additions to my portfolio, one has a 500 million market cap, and the other one has a 6 billion market cap, but the float is actually under 20%. So I don't guide my analysis based on market cap, right? I just try to look for high quality companies regardless of how large they are. I obviously have an advantage that I'm an individual investor and I don't care as much about, for example, low float, right? But I imagine that a larger investor would probably care about, or a fund would probably care about low float. That's also why from time to time you also get opportunities, right? Because these funds cannot access some of these companies. I would also say that before I used to only share research for companies that I was going to add to my portfolio. But now I'm pivoting a bit and I'm also sharing some articles of companies that I might be studying, but that I don't want to include in the portfolio, maybe due to the company itself or valuation reasons. So I think it becomes a more dynamic service, right? Because you are talking about more companies also. Maybe it's not such a detailed deep dive as the one that I'll publish when I add something to my portfolio, but at least you get to learn about new companies and also why I didn't decide to add them to the portfolio.
And beside best anchor stocks, which will be sure to get linked in the description below, is there anywhere else you'd like to point listeners if they'd like to learn more or get in touch with you?
I regularly post on Twitter @InvestQuotes, and also my direct messages are open, so they can also stay in touch through there.
Wonderful. Well, over the past year or so, you did a couple of presentations for our TIP mastermind community. Those were on ASML and John Deere, and both of those were just phenomenal, very well received by our members. So really appreciate you just being so giving of your knowledge, your time, and your expertise. And I think you do great work. And I'd encourage the listeners to go check out what Leandro's got going on and go follow him on Twitter. So thanks a lot, Leandro. I really appreciate the opportunity, and it's great to chat stocks with you.
Thank you very much, Clay, for inviting me. I had a great time.
You can't buy Apple stock today, assuming it's going to go from a $2 trillion to a $20 or $200 trillion company. It just isn't feasible. If you're wanting to buy a company that can grow for a really long time, you want to find something that is in its earlier stages of its growth. Chris shared some of his portfolio holdings on Twitter and his fund, which I'm very grateful for. And every company he owns has a market cap below $50 billion. Almost half of his portfolio is below $10 billion market caps. So he's looking for smaller companies, not companies that have a market cap in the hundreds of billions of dollars or in the trillions of dollars.